Hey, you're an economics major, right? Do you mind if I ask you a question about something I read today?
Yeah, I'm an economics major. What's your question?
Well, I read that the Federal Reserve targets the money supply. Could you explain this to me?
Wait. That's actually not how the central bank operates.
Really? Why not?
The central bank actually targets the federal funds rate, not the money supply. They implement a corridor framework to do this.
Oh really? Do you know anything about the corridor framework?
I do.
Do you think you could explain it from the beginning?
Sure.
First of all, what is the central bank?
The central bank is the national bank of a country that oversees and implements government monetary policy. Some of their goals include currency stability, low inflation, and full employment. In the United States, the central bank is known as the Federal Reserve.
Okay, that's straightforward enough. You said the Federal Reserve targets the federal funds rate. Could you explain what that is?
The federal funds rate is the interest rate at which a depository institution lends funds maintained at the Federal Reserve to another depository institution overnight.
Meaning what exactly?
Well, in simpler terms, the FFR is the interest rate at which private banks borrow and lend reserves to each other for one day. It is also known as the overnight rate.
Okay, so I get what the federal funds rate is now, but who cares? Why is it important for the central bank to target the federal funds rate?
Well, the federal funds rate is important for quite a few reasons. First, all other interest rates follow the federal funds rate. So by targeting the federal funds rate, the Federal Reserve indirectly targets all other interest rates. These other interest rates include the rate at which banks lend and the rate at which the public borrows funds. A high interest rate can be very costly for banks and the public.
Okay, so who determines what the target federal funds rate is?
A part of the Federal Reserve called the Federal Open Market Committee sets the FFR target to influence economic activity. They use open market operations to target the federal funds rate.
Open market, what? What are you talking about?
Okay. Maybe we should go over some key terms first. Bank reserves are private bank deposits at the Fed. Treasuries, or T-bills, are securities issued by the government. Treasuries are used to inject or drain reserves, in order to reach the federal rate target. This process is called open market operations. Let me show you how these dynamics work in a graph. This graph shows the fluctuations of the federal funds rate around its target rate. If the federal funds rate is too high, the government will buy T-bills, thus injecting reserves. This is noted by the orange section. As you can see, an injection of reserves lowers the federal funds rate. Likewise, if the federal funds rate is too low, the government will sell T-bills, thus removing reserves from banks. This is shown in the red section. As a result, a removal of reserves will increase the federal funds rate.
Okay. I get that. But why does the Federal Open Market Committee do this? Do open market operations have any effect on the economy?
That's exactly right. If the economy is growing too fast, the Federal Open Market Committee will raise the federal funds rate target so that borrowing is more expensive. This causes economic activity to decline, and inflation to decrease. However, if the economy is growing too slowly, the Federal Open Market Committee will lower the FFR target. As a result, the cost of borrowing is cheaper, which encourages people to borrow and to start businesses, and thus stimulating the economy. Does that make sense?
Yeah. That actually does make more sense now. But could we take another look at the graph? It seems like the federal funds rate is moving all over the place. Is there a way to accurately target the federal funds rate?
What a great observation. This is when the corridor framework comes into play.
Oh right. You mentioned that before. Can we talk about that a little bit more?
Well, in order for a central bank to reach its specific target overnight rate, they can implement the corridor framework, which will limit the volatility of the overnight rate. The corridor operating framework can help a central bank reach a target policy rate by stabilizing the overnight rate near its target rate.
Wait, so how does the central bank implement the corridor framework? Do you possibly have another graph for this?
I have graphs for everything. In order to implement this system, The central bank chooses a target overnight rate consistent with its goals for inflation and economic growth. The central bank supplies a certain level of reserves to the banking system, which it can influence through the open market operations that we previously talked about. At the top of the graph is the penalty rate, or the ceiling of the corridor. If all banks have less reserves than what they want, only the Fed can supply the extra reserves. The Fed will charge private banks for these extra reserves at the penalty rate. The floor of the corridor is the deposit rate. If banks have an excess of reserves, instead of trying to lend it in the overnight market, they can keep those reserves and receive a small amount of interest in return. As a result of this ceiling and floor, the corridor is established, which limits the fluctuations in the overnight rate. The overnight rate cannot be higher than the penalty rate, nor can the overnight rate be lower than the deposit rate.
Okay. That makes sense. However, I have a concern with this framework. If I remember correctly, I thought there was a stigma about banks going to the Fed for reserves. Wouldn't that mess up the corridor framework?
That's a great point. In order for the corridor system to work, the central bank needs to make sure that there is no stigma nor other non-monetary costs that would discourage banks from borrowing reserves from the Fed at the penalty rate even if the overnight rate is higher than the penalty rate. In addition, the central bank also needs to make sure that all institutions that have a surplus of reserves can earn interest through the deposit rate. Does that make sense?
Yeah, that's much clearer now. Yeah. But I remember reserves play a big role in the corridor system. Can you explain how they affect this framework a little more?
Sure. The corridor framework shows that the amount of reserves in the market does not affect the overnight rate, as previously believed. This means if the central bank increases the amount of reserves, the overnight rate will decrease no further than the deposit rate. Likewise, if the central bank decreases the amount of reserves, the overnight rate will increase no more than the penalty rate. Does that make sense?
Yeah, I think I understand. So therefore, the amount of reserves do not have a large effect on the overnight rate?
Exactly. Let's go back to the graph. The central bank could simply move the penalty and deposit rates to create a corridor in which all the overnight rates within that corridor would be an acceptable overnight rate for the economy. For example, this is a much narrower corridor than the one we previously saw. With this corridor system, a large amount of reserves does not drive down the overnight rate to zero, nor does a small amount of reserves skyrocket the overnight rate towards infinity. The overnight rate will stay within the corridor despite the amount of reserves.
That's amazing. Is there any way the central bank can make sure that the overnight rate equals its target rate?
Yeah, one way to do this is to set the overnight rate equal to the deposit rate and to leave a surplus of reserves. Then the FFR will lie at the bottom of the corridor.
Oh. That's because there will always be an excess of reserves, so there is no need for the overnight rate to increase to the penalty rate.
Exactly. Wow, you're really getting the hang of this. Secondly, the central bank can set a corridor of zero. Then the penalty rate will equal the target rate, which equals the deposit rate. This method would perfectly target the overnight rate, as all the rates are equal to the target overnight rate. So, there is no room for any volatility with the overnight rate. Hopefully that gives you a brief idea of how the central bank operates.
Yeah, wow. I had no idea what the corridor framework was before talking to you.
Don't forget about open market operations. Those are also important.
Right. Thanks for teaching me about central bank operations. Economics majors are so smart.
I'm just glad I could help.